I don't say this often, but I'm saying it now. Your savings are at serious risk in 2026. I've spent more than 7 decades watching how money moves, how economies crack, and how ordinary people lose wealth they thought was safe. I've seen the great inflation of the 1970s, the tech wreck, the financial crisis, and a dozen smaller disasters in between. Each time, the people who got hurt the worst were the ones who believed the system would protect them without asking hard questions. I'm 94 years old. I don't have time for alarmism or clickbait. But when I look at the data, at the policy decisions being made, at the way money is positioned right now, I see something that worries me more than almost anything in recent memory. The danger isn't just in the stock market. It's in your bank account, your bonds, your pension, the places you think are safest. Let me show you why. On the surface, everything looks fine. I see it every day. People check their phones, open their banking apps, and see their balances sitting there in neat rows, green numbers, positive returns for the year. Their 401 statements show growth. Their home values are up. Unemployment is low. The stock market, despite some wobbles, is near all-time highs. If you're like most people, you look at that screen and think, I'm doing okay. My money is safe. I've got a job, a house, some savings, maybe a pension or a retirement account. What could really go wrong? I understand that feeling. It's comfortable. It's reassuring. And that's precisely what worries me. Because I've seen this movie before. I've watched people feel exactly this safe right before the ground shifted under them. In 1999, everyone believed the internet would make the old rules obsolete and that stock prices could only go up. In 2006, people were convinced that housing prices never fall and that their home equity was as good as cash in the bank. In both cases, the comfort was real. The numbers on the screens looked good, and in both cases, millions of people who thought they were safe saw their wealth cut in half or worse. The pattern is always the same. When almost everyone stops asking hard questions, when confidence becomes universal, when the idea of serious trouble feels remote and almost quaint, that's when the risks are actually highest. Not because the world is about to end, but because people stop preparing. They stop thinking critically about where their money actually is and what could happen to it. Right now, in late 2025, I see that pattern again. I see people trusting that the system will protect them, trusting that central banks and governments have learned their lessons and won't let anything bad happen, trusting that the FDIC sticker on the door means their deposits are perfectly safe no matter what, trusting that a balanced portfolio of stocks and bonds will weather any storm, trusting that inflation is under control and that their purchasing power is secure. But trust, when it's not backed by clear-eyed understanding, is just another word for hope. And hope is not a strategy. Let me tell you what I see when I look under the surface. I see a financial system that has been stretched and twisted by more than a decade of policies that were supposed to be temporary. I see asset prices in many sectors that only make sense if nothing ever goes wrong. I see debt levels, both public and private, that have quietly grown to levels we've never tested in peacetime. I see geopolitical tensions that can flare into economic disruptions overnight. And I see a public that has largely stopped worrying about any of it. That combination, comfort plus fragility, is what keeps me up at night. Because when the risks are invisible to most people, they don't take the basic steps to protect themselves. They don't ask where their money really is. They don't read the fine print on their accounts. They don't think about what happens if interest rates move sharply, or if inflation comes back, or if the government changes the rules under pressure. Technology makes it worse. You can check your balance 100 times a day on your phone. You can see real-time charts that make you feel in control. But that constant feedback creates an illusion. It makes you think you're watching your money closely, when really you're just watching a number on a screen. You're not asking what that number represents, what promises back it up, or what could make those promises fail. Most people have never seriously considered what happens if the bank that holds their savings faces a run, or what happens if the mutual fund they own has to sell assets in a falling market just to meet redemptions, or what happens if inflation runs at 6% while their savings account pays 2%, slowly and quietly eroding their future. These aren't wild scenarios. They're things that have happened before. In my lifetime, in this country. So why would someone like me be worried now? What is it about 2026 specifically that makes me think your savings are at risk? It's this. We are heading into a period where several big, slow-moving forces are going to collide. Government debts that have been building for years will face refinancing pressures. Demographic shifts will strain pension systems and entitlement programs. Policy decisions made in response to past crises, decisions that papered over problems rather than solving them, are going to be tested. And all of this is happening at a time when the public's guard is down, when people feel safe, when they're not prepared. Let me think back to a moment in history. Late 1999, I was watching people do things with money that made no sense to me. They were buying companies that had never made $1 of profit and never would. They were taking out second mortgages to day trade internet stocks. They genuinely believed that the rules of business valuation had been permanently suspended by something called the new economy. I remember sitting in my office in Omaha and saying publicly that I didn't understand these valuations. People thought I was out of touch, old, behind the times. The market kept going up for months after I said that. But I knew what I was seeing. I was seeing the late stages of a mania, the point where prudence looks like cowardice and caution looks like incompetence. Then it all came apart. The NASDAQ fell from over 5,000 to under 1,200. People who had felt wealthy on paper saw 70%, 80%, sometimes 90% of their net worth disappear. The money didn't go somewhere else. It just vanished because it was never really there in the first place. It was a collective delusion, a number on a screen, backed by nothing but the belief that someone else would pay more tomorrow. I saw it again in 2006 and 2007. This time it was housing. People buying homes they couldn't afford with loans, they didn't understand confident that prices would keep rising forever. Banks packaging those loans into securities and selling them as safe investments. Rating agencies slapping AAA ratings on garbage. Everyone making money, everyone confident, everyone certain that this time was different. I was asked in 2003 about the housing market and derivatives. I call derivatives financial weapons of mass destruction. People dismissed that too. They said I didn't understand modern finance, that these instruments spread risk and made the system safer. Then 2008 happened. Lehman Brothers collapsed. AIG had to be bailed out. The entire global financial system came within hours of seizing up completely. Millions of people lost their homes. Trillions of dollars in wealth evaporated. Unemployment doubled. The pattern is always the same. Comfort, overconfidence, a belief that the present will simply extend into the future without disruption. And then, when almost no one is prepared, reality reasserts itself. Not because the world ended, but because the assumptions people built their plans on were wrong. What worries me now, at the end of 2025, is that I'm seeing that pattern again. But this time it's more subtle. There's no obvious mania like dot-com stocks or subprime mortgages. On the surface, things look reasonable. But when I dig into the structure underneath, I see the same kind of fragility. I see people trusting in things that may not be as solid as they think. When I say your savings could be wiped out in 2026, I'm not predicting the end of the world. I'm saying that the foundation under your money, the assumptions that make you feel safe, may be far weaker than you realize. And if I'm right, the people who will suffer most are the ones who never saw it coming, who never asked the hard questions, who trusted that someone else was looking out for them. The ground doesn't move all at once. It drifts. The system holding your savings looks solid until you examine what it's built on. Think of it like a house. From the curb, it looks fine. Fresh paint, nice lawn, everything in order. But what if the foundation has been slowly cracking for years and no one bothered to check? That's where we are with the financial system at the end of 2025. Start with government debt. The United States federal debt now exceeds $35 trillion. That's trillion with a T. To put that in perspective, when I started investing seriously in the 1,950 seconds, the entire federal debt was under $300 billion. We've added more debt in the last 15 years than in the entire previous history of the Republic combined. Now, debt itself isn't automatically bad. If you borrow to build something productive, something that generates returns greater than the interest cost, That can make sense. But a large portion of recent debt hasn't gone to productive investment. It's gone to consumption, to covering shortfalls, to paying interest on previous debt. That's a very different animal. Here is why this matters to your savings in 2026. Much of that debt will need to be refinanced. Bonds mature, new bonds have to be issued, and if the market demands higher interest rates, which is likely given inflation pressures and the sheer scale of borrowing, the government faces a choice. Either accept those higher rates and watch the debt service costs explode, or pressure the Federal Reserve to keep rates artificially low and accept higher inflation. Both options hurt savers. Higher interest rates can crash asset prices. Bonds lose value when rates rise. Stock valuations compress. Real estate slows. Your portfolio takes a hit, but keeping rates too low while inflation runs means your purchasing power erodes. Your bank account might say $100,000, but that $100,000 buys less and less each year. You're being quietly robbed by currency debasement. Then there's the private sector. For more than a decade after 2008, interest rates were held near zero. That created an environment where people and companies borrowed heavily because money was essentially free. Corporate debt levels are near all-time highs. Household debt is elevated, and much of that debt was taken on assuming rates would stay low forever. But rates didn't stay low. They've risen significantly since 2022. Companies that could easily service debt at 2% interest are now struggling at 7%. Some will default. Some will cut costs, meaning layoffs and reduced investment. The ripple effects flow through the economy and land eventually on your 401 statement or your pension fund. There's also the issue of asset prices. When interest rates were near zero, investors had no choice but to reach for yield. They bought stocks at high valuations. They bought real estate at elevated prices. They bought bonds with razor-thin spreads over treasuries. They did this not because these were great values, but because sitting in cash earning nothing felt worse. That dynamic has created bubbles, or at least bubble-like conditions, in various sectors. I look at certain parts of the market and I see prices that only make sense if everything goes perfectly for the next decade. No recession, no policy mistakes, no geopolitical shocks, no surprises. But there are always surprises. That's the nature of the world. And when surprises hit overvalued markets, the repricing can be swift and brutal. You don't get a gentle decline. You get a gap down, a rush for the exits, and by the time you think about selling, the damage is done. Then there's the policy uncertainty. We're in an environment where governments around the world are willing to intervene in markets in ways that were unthinkable a generation ago. Capital controls, windfall taxes, sudden regulatory changes, emergency measures that rewrite the rules overnight. That unpredictability is itself a risk because it makes long-term planning nearly impossible. These aren't wild theories. These are observable structural features of the current system. And they're all coming to a head around 2025 and 2026 as old policies expire, new administrations make decisions, and the bills for past choices come due. The question isn't whether these forces exist. They clearly do. The question is how they'll play out and whether your savings are positioned to survive what comes next. What does it really mean when the system wobbles? Let me paint you a picture with actual dollars, not abstract theory. Imagine you're a typical household. You've got $80,000 in your bank savings account. You've got another $250,000 in a 401, mostly in index funds. You've got a house worth maybe $400,000 with $150,000 left on the mortgage. On paper, you're doing fine. You're comfortable. You check your balances once a month and everything looks stable. Now let's walk through what can actually happen to each of those pieces if the structural problems I just described start to bite in 2026. Start with that $80,000 in the bank. Most people believe it's completely safe because of FDIC insurance. And up to $250,000 per depositor per bank is indeed insured. But here's what that really means. If the bank fails, you'll eventually get your money back. Eventually. It might take weeks or months. And what you get back is the nominal dollar amount, not the purchasing power. If inflation's running at 6% or 7%, which is entirely possible given the debt dynamics and policy pressures I mentioned, your $80,000 loses about $5,000 in real value every year. In 5 years, you've lost a quarter of its purchasing power. The number on the statement stays the same, but what it can buy keeps shrinking. That's the quiet erosion most people never see coming. And if the bank pays you 2% interest while inflation runs at 6%, you're falling behind by 4% per year. The bank is using your deposits to make loans at much higher rates, pocketing the difference while you get poorer in real terms. You're subsidizing the bank's profits with your own wealth. Now, the 401, that $250,000 is probably spread across stock index funds and maybe some bond funds. If we hit a period like we saw in 2022, where both stocks and bonds fell together, that balance can drop 20% or 30% in a matter of months. Suddenly, you're looking at $175,000 or less. If you're close to retirement, that's devastating. You don't have time to recover. Your entire plan just got derailed. But it gets worse. If the market drops and you panic and sell, you lock in those losses. Then, even if the market recovers, you miss the rebound because you're sitting in cash watching from the sidelines. I've seen this pattern destroy more wealth than almost anything else. People hold through the gains, sell in the panic, and miss the recovery. It's the exact opposite of what they should do. But fear is a powerful force. The house is another vulnerability. If interest rates spike, mortgage rates go up, and suddenly fewer people can afford to buy. Demand drops, prices soften or fall. Your $400,000 house might be worth $350,000. You haven't lost anything unless you sell, but if you need to move or refinance, that loss becomes very real. And if the economy weakens enough that you lose your job, you're in a position where you might be forced to sell at the worst possible time. There's also the risk that taxes change. Governments under fiscal pressure do predictable things. They raise taxes, property taxes, capital gains taxes, income taxes, fees and levies that aren't called taxes but function the same way. Each one takes a bite out of your net worth and your cash flow. Then there are the products many people think of as safe: treasury bonds, municipal bonds, corporate bonds. These all lose value when interest rates rise. If you bought a 10-year treasury paying 2% and rates go to 5%, your bond is worth significantly less on the open market. You can hold to maturity and get your principal back, but you miss years of higher returns you could have earned elsewhere. Money market funds, which a lot of people use as a cash alternative, can also break the buck in severe stress. It's rare, but it happened in 2008. When a money market fund's net asset value drops below $1, it creates a run as everyone tries to pull their money out at once. Again, you're insured up to a point, but the timing and the hassle and the uncertainty can be painful. The through line in all of this is that what looks safe in calm times can turn out to be fragile when the system is tested. Your bank account, your 401, your house, your bonds, these aren't abstractions. They're specific claims on specific institutions and specific markets. And when those institutions and markets come under pressure from inflation, from rising rates, from defaults, from policy chaos, your wealth is at risk whether you're paying attention or not. This is why I'm issuing a red alert, not because I think the world is ending, but because I think 2026 is shaping up to be a year where a lot of these pressures converge. And if you're not prepared, if you haven't thought through what could actually happen to your specific savings, you could wake up one day and discover that the comfortable assumptions you built your life on were wrong. Let's talk about where your money probably is right now. I want you to mentally walk through your own situation as I describe what I see in most households. Most people have their savings split across a few buckets. There's the checking account for daily expenses. There's a savings account, maybe earning 3% or 4% if you shopped around. There's a 401 or IRA, probably in target date funds or index funds that someone at work recommended. Maybe there's a brokerage account with some individual stocks or mutual funds. There might be a 529 plan for the kids. And for many people, the biggest single asset is the house. Ask yourself right now, do you actually know how much you have in each of those buckets? Do you know what you own inside those funds? Do you know what the fine print says about withdrawal restrictions, fees, or penalties? Most people don't. They see a total number on a dashboard and assume someone competent is managing the details. That assumption, that trust in the system, is exactly what worries me. Let me point out where the vulnerabilities are hiding. First, concentration risk. Most Americans have the overwhelming majority of their net worth tied to the United States economy. Their job is here. Their house is here. Their retirement accounts are invested primarily in U.S. stocks and bonds. That's a massive bet on one country, one currency, one political system. If something goes wrong here, everything you own gets hit at once. Second, there's the currency risk that almost no one thinks about. All your dollars are denominated in dollars. That sounds obvious, but think about what it means. If the dollar loses purchasing power through inflation or devaluation, every dollar you own buys less. You haven't diversified away from that risk at all. You're fully exposed. Third, there's the complexity problem. Many of the products sold to ordinary savers are far more complicated than they need to be. Target date funds that hold other funds that hold baskets of securities. Annuities with riders and caps and participation rates that take a lawyer to understand. Bond funds that don't actually behave like bonds. You're being sold things you don't fully understand, and that opacity creates risk. Fourth, there's the leverage problem. Even if you personally don't use margin or borrow to invest, the funds you own the companies in your index fund might be loaded with debt. The bank holding your deposits is leveraged 10 or 15 to 1. You think you're being conservative, but you're indirectly exposed to leverage everywhere. And fifth, there's the time horizon mismatch. You're saving for something decades away, but you're holding assets that can swing 30% or 40% in a single year. When those swings happen, your behavior changes. You get scared, you sell, you lock in losses. The mismatch between your long-term goal and your short-term emotions sabotages the whole plan. Now contrast this with how I think about owning a piece of the future. I don't own products. I don't own things that promise me returns based on complex formulas. I own businesses, simple, understandable businesses that make products or provide services that people need and will keep needing. I'm not buying a ticker symbol or a fund with a clever name. I'm buying a fractional ownership stake in a real enterprise with real assets, real customers, and real cash flows. And am only buying it when the price makes sense relative to what I'm getting. I don't use leverage. I don't borrow to invest. The businesses I own might carry some debt, but it's modest and it's used productively. I want to sleep well at night, and leverage is the enemy of sleep. I keep a substantial portion of my wealth in cash or very short-term treasuries, not because I think it's the highest returning asset, but because it gives me options. When markets panic and prices fall, I can act. I can buy things that are suddenly cheap. Most people can't do that because they're fully invested and often leveraged. When the storm hits, they're forced sellers at the worst time. I want to be a buyer. I avoid complexity. If I can't explain what something is and how it makes money in a few simple sentences, I don't buy it. Wall Street loves complexity because it justifies fees and obscures risk. I love simplicity because it clarifies both. And I accept that I'm going to miss some big winners. I'm never going to own the hottest stock or the trendiest sector. I'm fine with that. I'm not trying to hit home runs. I'm trying to avoid strikeouts. Compounding modest, reliable returns over decades is how you build real wealth. Swinging for the fences is how you end up broke. The gap between how most people are positioned and how I would position money if I were starting over is enormous. Most people are trusting strangers with complex products they don't understand, holding assets that are overvalued, exposed to risks they haven't thought through, and one bad year away from panic selling at a loss. That's not a robust plan. That's a plan that only works if nothing goes wrong. And in 2026, I think a lot is going to go wrong. If I were in your shoes, here's how I'd approach the next few years, not as financial advice, because I don't know your specific situation, but as a set of principles that have guided me through every kind of market for 7 decades. First, I'd build a cash cushion if I didn't have one already, not your emergency fund for car repairs or medical bills. That's separate. I'm talking about real money, enough to cover 6 months to a year of living expenses, sitting in the safest, most liquid form you can find. Treasury bills, a high-yield savings account at a sound bank, money market funds that invest only in government securities. This is about earning a return. This is about having options. When markets crash and everyone is selling in a panic, the person with cash can buy. When your company announces layoffs and you need time to find the right next job, not just any job, cash gives you that time. When opportunity appears, cash lets you move. Most people never build this cushion because it feels like dead money. But cash isn't dead, it's patient. And patience has enormous value. Second, I'd look hard at what I own in my retirement accounts and brokerage accounts. If you're holding expensive, actively managed funds with high fees, I'd move to low-cost index funds. The data is overwhelming on this. Over time, low fees matter more than almost anything else. A 1% annual fee doesn't sound like much, but compounded over 30 years, it can eat a third of your returns. But beyond fees, it asks whether what you own makes sense. Do you understand the businesses in your index funds? Do you believe they'll still be relevant and profitable in 10 or 20 years? If you're holding speculative positions, things you bought because they were hot or because someone on the internet said they'd go to the moon, I'd seriously consider exiting those. Speculation is fine if you can afford to lose the money, but if it's your retirement savings, that's not the place for it. Third, I'd avoid leverage entirely. No margin, no borrowing to invest, no option strategies that sound clever but expose you to unlimited downside. Leverage amplifies gains, yes, but it amplifies losses more. And it forces you to sell at the worst possible time. In every market crash I've seen, the people who got truly destroyed weren't the ones who owned stocks that fell. It was the ones who owned stocks on margin and got margin calls. They had to sell at the bottom, locking in catastrophic losses, while people without leverage could hold through and recover. Fourth, I'd focus on quality and durability. If you're going to own individual stocks, own companies that have competitive advantages, companies that make products people need, not just want, companies with strong balance sheets and manageable debt, companies run by people who think like owners, not like hired managers trying to hit quarterly numbers. It'd look for businesses with pricing power. When costs go up, can they raise prices without losing customers? That's the hallmark of a strong business. It's also your best defense against inflation. If the company you own can pass costs through to customers, your ownership stake retains its real value even as the currency weakens. Fifth, it'd lengthen my time horizon and shorten my attention span to daily market moves. This sounds contradictory, but it's not. You should be thinking about where you want to be in 10 or 20 years. But you should stop checking your portfolio every day. The daily moves are noise. They're random. They'll drive you crazy and tempt you to trade when you should be sitting still. I've said before that the stock market is a device for transferring money from the impatient to the patient. If you can train yourself to ignore the noise, to hold quality assets through the ups and downs, you'll do vastly better than people who are constantly reacting. Sixth, I'd be very cautious about chasing yield. When interest rates were near zero, people felt forced to take risks just to earn something. They bought high-yield bonds, REITs, dividend stocks, anything that promised income. But yield always comes with risk. High yields often mean high risk of losing your principal. I'd rather own a great business that pays a modest dividend and grows over time than a mediocre business that pays a fat dividend today but might cut it tomorrow. And seventh, I'd pre-decide certain things before the storm hits. Write down, right now, at what point would I rebalance? If stocks fall 20%, will I buy more? If they fall 40%, will I double down? Having a plan in advance when you're calm makes it much easier to act rationally when everyone around you is panicking. These aren't complicated strategies. They're not exciting. You won't get rich quick following them. But you will, over time, build real wealth. And more importantly, you'll avoid the catastrophic mistakes that wipe people out. Having a plan is one thing. Sticking to it when the world is shaking is another. And that's where most people lose the game. Imagine it's March of 2026. You wake up, the market is down 5%, alarming headlines everywhere, your phone lighting up with panic. What will you actually do in that moment? That's the question that matters. I've watched this pattern in every crisis. In 1987, when the market fell 22% in one day. In 2008, when people held through the drops but finally capitulated at the bottom in March 2009, missing the greatest rally in history. The problem isn't panic itself, it's not having a plan for how to handle it. They didn't pre-decide what they'd do, so when fear took over, they made emotional decisions that destroyed wealth. So how do you know when to hold and when to cut losses? Focus on what you own, not what it's trading for. If you own a piece of a good business that's still performing well, a falling stock price is just noise, maybe even an opportunity to buy more. But if you own something you don't understand, or something you bought because it was going up, a falling price might be telling you something important. Write down now, today, before the storm. If the market falls 20%, I will buy more of X. If it falls 40%, I will deploy Y amount of cash. If my positions fall but the businesses are sound, I will hold. Having that written plan means you don't have to make the decision in the heat of the moment. Ask yourself right now, do I have that temperament? Can I sit still when everyone else is running? If the honest answer is no, position yourself more conservatively now before the test comes. I've lived through more economic cycles than most people will ever see. I've watched fortunes made and lost. I've seen the arrogant humbled and the patient rewarded. And at this stage of my life, I don't have time for drama or exaggeration. When I say something, I mean it. So when I tell you that your savings could be wiped out in 2026, I'm not trying to scare you for entertainment. I'm telling you because I see structural problems in the financial system that most people aren't paying attention to. I see debt levels that are unsustainable. I see asset prices that only make sense if nothing goes wrong. I see policy uncertainty that makes long-term planning nearly impossible. And I see a public that feels comfortable, that trusts the system, will protect them, that hasn't asked the hard questions about where their money actually is. That combination, comfort and fragility, is what worries me most. But here's the thing. Your savings don't have to be wiped out. This isn't some inevitable disaster that you're powerless to prevent. You have agency. You have time right now, at the end of 2025, to make changes. The decisions you make in the next few months could determine whether 2026 is the year you lost everything or the year you positioned yourself to survive and even prosper. Let me boil it down to a few core principles, because simplicity is what matters when things get complicated. First, understand where your money actually is. Not the account name or the fund name, but what you truly own. Pull out your statements tonight. Look at every line. Ask yourself, do I understand this? Do I know what would happen to this in a crisis? If you can't answer those questions clearly, that's a red flag. Second, reduce the obvious points of fragility. If you're heavily leveraged, reduce that leverage. If you're concentrated in one asset or one sector or one country, diversify. If you're holding things you don't understand or that only work in very specific conditions, consider simplifying. The goal isn't to maximize returns in the next year. The goal is to make sure you're still in the game in 5 or 10 years. Third, own productive assets that you understand. Businesses that make things people need. Businesses with pricing power and manageable debt. Not speculation, not bets on sentiment or momentum, but ownership of real enterprises that generate real cash. And own them at prices that make sense. Fourth, keep cash. Real, liquid, safe cash. Enough to weather a storm without being forced to sell at the bottom. Enough to take advantage of opportunities when they appear. Cash feels boring when markets are going up, but it's the most valuable thing you can own when markets are going down. Fifth, control your behavior. Plan now while you're calm for what you'll do when fear hits. Write it down. Commit to it. Because when the panic comes, and it will come, your emotions will lie to you. They'll tell you to sell when you should be holding or buying. They'll tell you to chase when you should be cautious. Having a plan you made in advance is the only way to override that. And sixth, accept that you're going to miss some things. You're not going to catch every rally. You're not going to own the hottest stock. You're going to watch other people make money on things you don't understand or don't trust. That's fine. Your goal is to compound wealth steadily over decades, not to hit home runs or impress people at dinner parties. These principles aren't new. They're not complicated. They're not sexy, but they work. They worked for me for 70 years through every kind of market you can imagine. And they'll work for you if you have the discipline to follow them. The alternative is to do nothing, to keep trusting that the system will protect you, to keep assuming that what worked yesterday will work tomorrow, to keep checking your balance on an app and assuming the number you see represents something solid and safe. Maybe I'm wrong. Maybe 2026 will be a calm year. Maybe all the structural problems I've described will somehow resolve themselves without pain. Maybe the debts will be managed, the asset bubbles will deflate gently, the policy uncertainty will clear, and everyone's savings will be fine. But I've been doing this too long to bet on maybe. I've seen too many people lose too much because they trusted in things that turned out to be fragile. I've learned to prepare for trouble even when everyone else thinks I'm being overcautious. You don't have to take my word for it. You don't have to follow my advice. But I do ask you to do one thing. Sit down with your financial statements tonight. Look at them honestly. Ask yourself the hard questions about what you own, where you're vulnerable, and what you'd do if things went wrong. Because time is still on your side. The storm I'm worried about hasn't hit yet. You can still make changes. You can still prepare. But that window won't stay open forever. Your family, your future, your independence, they all rest on the decisions you make with your money. Don't leave those decisions to chance or to blind trust in a system that might not be as solid as it looks. Take control. Ask questions. Make changes where you need to. That's all I've got to say. I've given you my perspective, shaped by 7 decades of watching markets and people. What you do with it is up to you.